Hi, everyone. It's Brad Thomas, and welcome to the Wide Moat Show. Today, I'm joined with Nicholas Ward, who's a fellow analyst here at Wide Moat Research. We want to welcome you to our first inaugural Wide Moat Show, and we're looking forward to doing many more of these in the future. It's good to see you today. Nick, it's good to see you.
Yeah, thanks, Brad. This has been a long time in the making. I know we both wanted to do this, and now we finally kind of have the platform to make it work. And, we're looking forward to kind of teaching you guys and hopefully entertaining you guys as well.
Great. Well, little background. Some of you may know me and Nick from Seeking Alpha. We both spent over 10 years each on Seeking Alpha, writing a lot of content there. And we, of course, gravitated now over to launch Wide Moat Research just a few years ago. So really excited to be on this platform and to be able to every week provide you with a lot of our research and ideas to help you navigate through a lot of this volatility that we're seeing today in the markets. And of course, Nick, you joined me on Seeking Alpha as well.
Yeah, we talked about this. It's been a long time. Brad asked me, how long have you been writing Seeking Alpha? And I feel like an old man now. It's like almost 13, 14 years. And then I think, Brad, you've been there a little longer. We're not there anymore. So now if you guys have been following us, this is one of the best places to find Brad and I. We're going to do the show every week. And, it'll be a different subject each week, whatever we think is kind of most pertinent to the market today. But we also, I think, kind of wanted to introduce ourselves to people that did not know us from Seeking Alpha or some of our other publications that we've done. So, Brad, your resume is very impressive. So why don't you start with that and kind of let everybody know who you are?
Sure. Well, of course, I won't bore you with the life before I was a writer. I was in the real property business, and I built a lot of shopping centers and different real estate properties. And of course, as a result of the Great Recession, I pivoted and moved over to what I call the intellectual property business, which is frankly just writing and providing research to my hundreds of thousands of clients around the world. And of course, I cover real estate. That's really background, something that my passion is, but also we cover a variety of other sectors, business development companies, utilities, preferred shares, dividend aristocrats. Those are the companies that increase dividends every 25 years. Dividend kings, of course, those are the 50-year record of dividend growth. And so we have a very large universe that we cover here. And so I'm really excited to be able to provide this type of research in this type of format, in this video format, because it's really interactive. We want to be able to provide our audience with not only our words, but also some action and show you exactly, what these businesses are and how they operate and what are these various wide moats.
And Brad, you may be selling yourself a little short here. I think you mentioned interaction. I know you had talked about doing a giveaway. Brad is a published author, several books. I don't know if you guys will learn more about us as time goes on. But Brad, do you want to talk about your giveaway in the comment section?
Yeah, actually, I have the book here. And actually, this is actually the, I guess a CD or something. But I've got this Read for Dummies book. I just published this book last year. This is my first Dummies book. I'm excited to do several more of these in the future. But anyway, Reads for Dummies. And we're going to do something every week. We're going to send you one free copy for somebody who comments on our comment stream. We'd like to see a lot of engagement here on our YouTube channel here. So definitely drop us a comment below, and we're going to send one of these out every single week.
Yeah, that'll be good. And, if that's not enough kind of draw for your comments, let us know. We can maybe up the ante if we have to. But, it is a great book, and I've read it, learned a lot. Brad actually kind of turned me on to REITs a long time ago, and we'll talk about that more in this show, what a REIT is and why somebody might invest in one of those. But I guess quickly, I'll talk about me. I kind of cover, Brad's more of like a hard asset type of guy, real estate, infrastructure, MLPs, telecom. I kind of focus on more kind of asset light things. I really appreciate Brad's pivot from the real estate developer to the writer. He went from a pretty asset heavy business model to a very asset light business model. Well, asset light business models are what I kind of specialize in, what I focus on. Asset light, toll booths type businesses that are highly profitable, very high margins, and that also return that cash to shareholders. So in my opinion, those are the best types of companies to own. And as the show goes on, we can kind of show you guys, how we've made a lot of money with these types of companies and how you might be able to as well. So, Brad, I think, that's with us out of the way, and I think we're going a little over here, but that's all right. Let's talk about Wide Moat really quickly. We did just start this company not too long ago. Like we said, a lot of you guys probably know us from other platforms, so we want to kind of introduce everybody to Wide Moat, and then I promise we're going to get into some pretty actionable ideas here in just a moment.
Great. Well, let's start out with, a lot of people have asked me, at least, and probably Nick as well, why do we call this company Wide Moat? Well, Warren Buffett said it best. The most important thing in evaluating businesses is figuring out how big the moat is around the business. I want to know how big the capital is on the inside, and then I want to know how big the moat is around it. What you love is big capital and a big moat. That's a lecture by Warren Buffett. Now, there's 5 different really primary moats that we like to look for within companies. And I'll just go touch on these very, very quickly so we can get into some of these companies today. But advantage number 1 is intangible assets. Those are like licenses or patents or regulatory approvals or even brands. When you think about companies like Nike and Apple, you know what this brand is and what those moats are around those companies. The second attribute we look for is the cost advantage. Now, this is extremely important because the way that companies are able to generate durable earnings over time, which of course means dividend growth as well, is that they participate or they have this cost advantage. So when I think of a cost advantage, I think of companies like Walmart or Target. These are companies that are they are able to provide excellent balance sheets that drive those returns. And we've got a couple of those I'm going to touch on here later below.
And I guess they also have great pricing power. So you talk about Walmart. Walmart gets hit with all these tariffs. Well, they're able to pass that along to consumers better than most because people aren't not going to go to Walmart. Same thing with like Netflix. Some of these companies, if you guys have subscription services, I'm sure you've seen those prices go from $7 to $9 to $12 to $15 to $20. In a decade, we'll probably be paying $50 a month for Netflix. But the thing is, we're still going to do it because we love the company. So that the cost of capital, also kind of pricing power kind of factors into that as well. You want to own companies that have such strong brands that they can raise prices and people aren't going to stop buying that product.
Absolutely. And that's why we spend a lot of time looking at these balance sheets, because a lot of that cost of capital really is rooted into those balance sheets. And we don't like to see companies that are over leveraged. We really like to see a disciplined capital structure. So that's something we really examine in great detail. The third advantage, Wide Moat advantage, is switching costs. And just like the name implies, the advantage here is you want to look at companies that cannot switch their business model, can't switch over easily to new customers. Now, one good example of that is probably, I'll share it right here, is this phone, Apple. How many times do you leave your Apple account and go to a new phone vendor? So switching, that's a good example of the switching cost and how companies can't switch easily. And again, Apple is a terrific example. And I think, Nick, you've got some more of those you're going to discuss here in a few minutes.
I can just quickly mention one now. That's a great example on the consumer side. We all kind of want our special text messages. Everybody knows, oh, this guy's got an iPhone. It makes you feel special. A lot of time on like the enterprise side of things, so on the business side of things, once a company has integrated a certain software into their kind of back end operations, they've trained up everybody on it. It works. It's doing what they want it to do. Having to retrain and repurchase something like software, it may not seem like a lot, but that actually is a pretty big problem for a company. So that's kind of an inherent switching cost as well if a company, makes a really great product.
Great. The fourth advantage, Wide Moat advantage, is network effect. And I'm going to talk about 2 companies here in just a minute, but the network effect is really simple. It means bigger is better. We like for companies that have that scale advantage. And a good example probably is in the credit card space is Visa. And Nick, I know you've covered Visa as well.
Yeah, we love and Visa and MasterCard. Honestly, those are duopolies, and there's a bunch of these. Coke, Pepsi, Visa, MasterCard. In the semiconductor space, there's only a handful of big companies. These companies have such big kind of client bases that they can't leave them. They have such big scale, and if somebody does leave, it's not a big deal. It doesn't really hurt the quarterly results or the annual results. So we love companies like that. Kind of on the other end of that spectrum, we are kind of hesitant to buy into stories where there's only 1 or 2 clients, like a Skyworks Solutions kind of comes to mind, like Apple, I think is something like 60-70% of their revenue. That's a pretty scary thing. I know it's a great company and their fundamentals are fantastic, but what if Apple just pulls the plug and develops their own hardware. That's, that would be a massive problem for them. So, those are the types of threats that we look to avoid. We look for wide moats, and we also avoid companies that, in our opinion, do not have them.
Great. Well, this is a great segue, I think, Nick, into our first pick on your side, which is a railroad company. Now, before we talk about that particular name, it was, I think, maybe 5, 6, 7 years ago. I think I was in Scotland. I flew out to the Money Show to speak at a conference there in London, and I took a long train. I don't know how long it was. It was all day. If you're familiar with this part of the world, you've got London on the south, and then you go all the way up the country of Scotland until you get to Aberdeen, which is where I was. And along the way, I took a train and had some great conversations with some Scottish folks there. And but I saw a number of castles that I thought were really interesting. And I thought what I would share with you is one of my favorite castles. And I haven't actually been there. Is in Edinburgh. It's one of the most famous castles in the world. I'm going to put that on the screen here. That castle is actually built on a volcano of all places. And again, the purpose of me talking about castles, of course, is when we talk about moats, we talk about those castles. I mean, what we want to do is see these companies, again, in the words of Warren Buffett, who have moats that protect these castles. And we want to see those castles as almost like fortresses who have fortress balance sheets, really strong management teams that run those castles. So every week, I'm going to try to drop one of my favorite castles in there. I may not do it every week, but I thought I'd do it today. Now, Nick, speaking of railroads, I took this railroad, again, to Scotland. I love the railroad business, but can you explain why are railroads considered moats, and which company do you like there?
Yeah, I mean, that's an interesting. Railroads are super boring. I see, people love those from the time they're a child. I have a 3-year-old son, and every time a train drives by, he can't take his eyes off of it. But from an investment standpoint, they're pretty boring, right? They don't do anything very special. They just move a lot of cargo around. But the kind of what they do is they move it super efficiently, and more importantly, they cannot be recreated. In today's world with environmental regulation, eminent domain issues, you just can't build a massive railroad track across America anymore. Kind of what's been done back in the 19th century and the 20th century. We're done with that. We're not building any more new railroads. We've actually consolidated that industry massively. I think there's only 6 Class 1 railroads in North America right now. So that's what we talk about with the moat. Union Pacific, I think, is a company I'm going to mention today. It's been paying a dividend for a long time. It's got an A-rated balance sheet. We'll throw up a map of the company's kind of territory, and you'll see they just dominate everything from the Mississippi River all the way to the Pacific Ocean. So that's all the stuff coming in from the Gulf of Mexico, all the stuff coming down from Canada, from the Great Lakes to Chicago, and then also coming in from Asia into like the Port of Los Angeles, Port of Long Beach. All those arteries in between that need all those goods. Union Pacific does that, and they do that very efficiently, and that's not going to change. Trains keep getting better. It might seem like old technology, but in like 200 years, there's still going to be trains all over the place. And, that's what we look for when we want to own businesses. We talk about owning, not trading. We're investors here. We want to buy stocks that we think will be around in 10 years and 50 years and 200 years. And there's not very many companies that I can say with a lot of assurity that there will be around in a century, but the railroads will be. I have no doubt. They're the most efficient, fuel efficient, energy efficient way to move heavy goods over land, and drones, EVs. None of that's going to change that. So, Union Pacific is a great company. We've had that in our portfolio at our front end service, the wide moat letter, for a long time now. We've done very well with that, and just no plans to sell that. That's the type of thing you can own for a very long time and just make a lot of money.
I'm going to put up a fast graph real quick, Nick. Look at the fundamentals. Of course, we study fundamentals rigorously at Wide Moat Research, and as you can see here in this screen share, this company has generated very reliable, very predictable earnings and dividends over a long period of time. And again, I can go all the way back. You can see.
Yeah, going back probably makes more sense here, right? Because there's some red. If you guys look down at the bottom, you'll see the EPS and the dividends. And you'll see all the black numbers that are good. You do see some red. This is a company that's economically sensitive, right? When we have a recession or a slowdown, yes, there's going to be less goods shipped on railroads. That's just what happens when the economy slows down. But just look a few years down the road. You have massive bounce backs. That's always happened. And, we don't know what the future holds here. Neither Brad nor I, have a crystal ball that works. But, I think history will continue to repeat itself with a company like this.
Yeah, and analysts are also bullish, just as bullish as we are. I mean, you can see the potential growth for this company. Again, analyst consensus are about 12%, so low double-digit growth in both 26 and 27, and 9% analyst consensus growth this year. So certainly see the demand here. Kind of moving on to the next pick we have here is one that's really dear to me, is the credit rating industry. Now, of course, in our coverage spectrum, and I look specifically in the REITs and BDC space, I always like to look at those credit rating agencies because those are extremely important in how we analyze the cost of capital advantage that I referenced earlier. So, Nick, what are your thoughts today on these credit rating agencies?
Yeah, I mean, you just touched upon it. You said it's one of the first things you look at as an analyst. It's certainly one of the first things that a company is looking at that's thinking about doing business with a REIT or any other company. The credit rating that a company has speaks volumes about its balance sheet, about its management's ability to kind of steward its capital, about its capital return policies. Are they being too aggressive? M&A policies, are they making bad decisions? So I think if there's one, it's usually a letter in this case. We talk about A-rated companies a lot. There's A, B, C, D. You can, just like a grade in school. That one letter, that S&P Global rating, is one of the most important things we look for. And with that in mind, thinking about companies that we would love to own over the long term, why not own the company that everybody's paying to get that rating? Brad, you talk about mission critical things a lot, whether we're talking about real estate, whether we're talking about a product or a service from any other industry. Well, this world revolves around debt. That's not going to change anytime soon. I actually expect to see interest rates fall and debt to rise and M&A to pick up in the coming years with the new administration in the Oval Office and in Washington, D.C. And a company like S&P Global or Moody's, who is also that kind of duopoly that we just talked about, they're going to be major beneficiaries. And I guess quickly, to finish this up, we kind of talked about Buffett. Brad, you mentioned the Buffett quote to kind of start this off. We obviously love the Oracle of Omaha at Moat. We kind of try to mimic a lot of his fundamentally driven analysis with our work. Well, Warren Buffett not only owns Moody's, but he's talked about the fact that he owns it because he can't understand why he has to pay for it. He owns Berkshire Hathaway. You would assume any company in the world would just trust a deal with them, but they still need the S&P or the Moody's credit score. So the fact that he said, I don't know why we have to pay for these things, but we do, we pay him a lot of money. Well, let's just include the company in the portfolio as well. And, that's something we would like to do as well. We don't actually own these companies in our modern portfolios at the moment because they're generally expensive. These are wonderful long-term compounders. That's what we're looking to own. And you can see here, wonderful earnings growth. The share price is pretty elevated. That's what happens when there's super reliable companies. People don't want to, they pay pretty high valuations for those, but up and to the right over the last 2 decades. So anybody that's owned a company like this for a long time has made a lot of money.
Absolutely. And look, if you had bought Moody's, for example, back during COVID, the depths of COVID, you would be sitting on something like 21% annualized returns a day. So this is a good example of buying these companies when they're cheap. And that's part of the process we do here at Moat Research. We not only look at the fundamentals of those companies, but we also, most importantly, look at this margin of safety. When's the best time to buy those companies? And again, I agree with you. Looking at this screen, Moody's has a very long history of predictable earnings and dividends as well. So that's a great pick. Nick, let's move over to another Buffett pick. And again, by the way, it's time for me to take a break here. Give you a little prop for the camera.
Well, pick me up.
Got a little Diet Coke here.
There you go. Yeah. And I'll go quicker. Everybody knows Coca-Cola, right? Brad talked about the brand recognition as a part of what a wide moat is. Well, Coca-Cola is one of the most recognizable brands in the world, but that's not why we like the company. It's not why I'm talking about the company right now. The reason that's great, but consumers' taste change over time. Health foods kind of movements happen and people don't want sugar or they don't want caffeine or whatever. I think Coca-Cola used to have cocaine in it. And, so that obviously changed. But what hasn't changed is their distribution network. And that's what sets Coke and Pepsi apart from every other beverage company in the world. They can create a product or just go take out a competitor And then within a week, that product is on the shelf of every grocery store, convenience store, fast food restaurant, amusement park, etc., in the world. And that's the kind of scale advantage that they have. And it's a boring company, a lot like a railroad. But if you just look at any long-term Coca-Cola chart, you might even ask yourself, how is this kind of boring consumer staple kind of just printing money for shareholders and returning all those dividends? Well, the answer is because nobody can compete with its distribution. Even just this morning, I saw PepsiCo spent, I think, $2 billion on Pop, or one of these kind of like prebiotic colas. Well, you better believe you're going to see that in the shelves quite a bit more. They're going to, get a pretty good ROI on that $2 billion, and they can pay more for a company because they know they can sell it better than anybody else. So, slow growth, steady growth, 3% dividend yield. Boring, but as Brad and I like to say, boring can be pretty beautiful when it comes to the stock market.
Absolutely. And you can see two of those wide moat advantages at work, being the scale advantage. Nick, you mentioned that large distribution network, global distribution network, as well as the cost of capital, A+ rated company. So definitely a great pick. Now, let's move over to, I guess, my wheelhouse, if you will, and we'll talk about some real estate investment trusts. And what's interesting is this first pick is actually, I could call almost a partner of Coca-Cola, because they're a tenant or a customer. And this company is Prologis. They're one of the largest industrial landlords, warehouse landlords in the world.
And Brad, can you explain to people what a real estate investment trust is? I know we say the acronym REIT all the time, and but I think there's probably a lot of people that may not know what that is. So before you get into Prologis, can you explain that to a viewer that may not be familiar?
Sure. And again, I want to remind everybody, I'm going to drop a free book below in the comments, and I'm going to send a book out for REITs for Dummies. So it's all in the REITs for Dummies book. But I'm going to give you basically a couple different quick attributes that are characteristics or attributes that make up a REIT. So REIT is a real estate investment trust. It was formed in 1960, so over 6 decades. The primary law that you should remember in REITs is that to be qualified as a REIT, the company must pay out at least 90% of their taxable incomes in the form of dividends annually. And most companies, by the way, pay out 100% of their taxable income in the form of dividends. So that is the primary reason that REITs have higher dividend yields than, say, traditional C corporations or ordinary stocks. And that is one of the key differentiators. So a very important attribute for REITs is the fact that they have this very predictable revenue stream, which drives those dividends. And a company like Prologis has done an extremely good job of that since the global financial crisis. I'm going to pull up a chart real quick. So here we have Prologis. And you can see going back through the global financial crisis. Now, first of all, Prologis did cut their dividend in 2008 and 9. Most REITs did cut their dividends in 08 or 9. There's just about 10 REITs that were able to go through the Great Recession, not the COVID, but the Great Recession, and increase dividends. This company, Prologis, again, cut the dividends during the Great Recession. However, since the Great Recession, they've generated best-in-class earnings and dividend growth, which is a low double-digit number, I think around 11 or 12% growth coming out of COVID through today. Now, in this cycle we're in right now, we've got these tariffs. And of course, the tariffs have created a lot of volatility in the market in general, but also as it relates to warehousing and what risks are going to weigh on warehousing during this tariff cycle. In my opinion, it's going to be actually a good thing, because what we're going to see, and again, I'm not trying to be political here, just trying to be realistic and understanding fundamentals. I think we're already seeing a number of announcements, another number of new companies that are going to be relocating to the U.S., and that demand is going to increase over the next, hopefully, 3 to 4 years. In fact, I've argued and written about this quite a bit. I think we'll see what I perceive to be a building boom over the next several years. And again, as corporate tax rates come down, that's also going to incentivize more businesses, more manufacturers, more companies who need warehousing to increase demand along the way. So we're extremely bullish with Prologis for those reasons. Now, scale and cost of capital come into play. Again, this is the largest warehousing REIT in the world, and also cost of capital. They have an A-rated balance sheet and are able to really drive their growth. Again, because of that A rating, they're able to obtain unsecured debt at some very attractive prices, as well as their equity multiple right now is just under 4%. So they're able to transact and continue to grow their earnings over time. This year, analysts are seeing about a 9% growth in 25 and 9% in 26, and low double digits around 12% in 27. So definitely in terms of the companies that we cover, the sectors that we cover, we think warehousing is certainly an appealing place to park money right now.
Yeah, this is the benefits from kind of two of the biggest themes that we like, right? The kind of the reindustrialization of America. We've been writing about that for years. We think onshoring and nearshoring started in COVID. People saw kind of how fragile the world's supply chains were, and there's almost like a national security component to this. You need to have the very most important things, the mission critical parts to your company nearby, so you can do that. And on that chart that Brad showed, you do see kind of 2013, 2014, Prologis' earnings took off. Well, kind of what happened then? That was when e-commerce really took off. That's kind of one of the biggest secular growth trends that has kind of been there for the last decade, and that's not going anywhere. I think there's still a pretty small percentage of goods overall that are purchased digitally, and that's only going to keep going. And a company like Prologis, will be a big beneficiary. Brad, I guess quickly, I know Amazon's spending a lot of money to kind of build out their own warehouses. That's what Prologis owns. They own these massive warehouses. You've probably seen them on interstates or on your local highways. Does it kind of scare you? I just know historically when Amazon enters into an industry, that's kind of like an 800-pound gorilla you don't want to mess with. But you still like Prologis, even with Amazon kind of coming onto their turf a little bit.
100%. In fact, Nick, I think probably we ought to save this for another session where we'll talk about sell leasebacks and the reason that companies like Amazon and a number of other companies don't need to be owning that real estate. It's much more efficient for Amazon to reinvest that capital into their business, into their technology business, which is extremely important. Remember, Amazon bought Whole Foods. You remember that a while back, and again, it's really important to grasp the concept of how Amazon makes money is investing in technology, not in real estate. Real estate's not going to generate the types of returns. So it's better for Amazon to be a tenant, and for companies like Prologis and the next company I'm going to talk about, Realty Income, to be a landlord of Amazon versus being a tenant, because again, Amazon can drive returns at low double digits or better with their technology platform. Whereas in real estate, you're only going to generate, 6-7% kind of cash on what I call cash on cash yields or returns. So it definitely makes more sense. Same thing goes to data centers, by the way. And I'll touch on, again, Realty Income and Net Lease REIT. Again, very similar to Prologis. The company has the scale advantage. They've got over 15,000 properties in all 50 states, as well as Europe. But what's interesting about this company, and really this whole sector that we're referred to as the freestanding net lease sector, and I just wrote on this today. Make sure you read our Wide Moat Daily articles, but I just wrote on this today. Net lease companies, the amount of properties across the world, it's trillions and trillions of dollars of freestanding properties. These are Amazon properties. They're Walgreens drugstores. They're O'Reilly Auto Parts. They're 7-Elevens. Just drive home or drive to your grocery store, and you're going to see all these buildings. And when you look at that whole amount of inventory, the REITs only own a very small, net lease REITs only own a very small percentage of these properties. So the opportunity here, and this is where a lot of investors miss this, the opportunity is to aggregate and consolidate these properties. I don't know of any other industry out there where there's so much opportunity to consolidate this highly fragmented business.
Yeah, now, that's big, Tam. Yeah, I was going to say, people think about Realty Income. If you go to Reddit/dividends, that stock's on there all the time. It's a very boring stock, but that's an interesting way to think about it, right? When we talk about high growth tech names, we talk about TAM, total addressable market. Well, like you said, if there's not that many companies with trillions, and at the beginning with that T at the beginning of their TAM. Well, it sounds like Realty Income, maybe could have that if they continue to kind of scoop up if they own only 15,000 buildings, there's got to be millions, tens of millions, hundreds of millions of buildings on the world that they can take over. And your sale leaseback point's a good one too, right? Like I follow Amazon pretty closely. Their ROIs and money invested in the cloud and in their AI initiatives are way more than that kind of 6-7%. Honestly, Andy Jassy would be fired if that's all they were generating with their cloud investments right now. So yeah, I guess that makes a lot of sense, kind of selling that real estate. I don't know if they'll do it, but that's interesting. We should get on the phone with them if we can.
Yeah, for sure.
Pitch that
Well, and that goes to another article I wrote about last week called Stick to Your Knitting, your circle of confidence. Amazon should stick to its circle of confidence, and Prologis and Realty Income should stick to theirs, which is being a landlord to these companies. Now, I pulled up the chart of Realty Income. This doesn't go all the way back. You could really go all the way back 30 years, which is how long this company's Realty Income has been a publicly traded company. And by the way, they've increased dividends every single year as a public company. And even before that, they had about 20 years as a private company. So you could say there's a 50-year history of dividend growth. But as a public company, 30 years would certainly qualifies them as a dividend aristocrat. But the really compelling opportunity here, again, we touched on the cost of capital, again, A-minus rated balance sheet. We watched the evolution of this company. By the way, Nick, I used to build stores back when I was a developer, and I sold some of these stores to Realty Income. So I've known about this company for a long time.
Yeah, you turned me on this a long time ago. I've owned it, done well. And I think you mentioned net lease REIT, and I bet a lot of people don't know what a triple net lease REIT is. And, like I said, I love the software space. That's kind of where, my passion lies. And I'm really looking for high margin businesses. Well, the fact of the matter is, I don't know if there's, NVIDIA, I think just came out with 72-73% margins. That's best in class. Well, these triple net lease REITs do much better than that. And Brad, why don't you explain why that is? Because people may not understand this business model, and it'll blow your mind, honestly.
Yeah, actually, again, I wrote about net lease today, and when I owned duplexes or single family rentals, you collect the rent, and you have to pay out taxes, you have to pay out insurance, you have to pay out maintenance. There's trash, there's eviction if they don't pay rent. There's management fees. There's all kinds of these expenses that go into these single family rentals or rentals. And by the time you net out and net out those expenses and derive your net operating income, what's left is what's left for you for yourself or your own dividends. And so the great thing about net lease REITs is there's really no frictional cost. You collect a rent check. When I got a rent check from, say, CVS, basically there's nothing there. CVS pays the taxes, CVS pays the insurance, they pay the maintenance.
And they're in the contract, right? Like, so they're not doing that out of the goodness of their heart. When Realty Income signs a lease with a company, they say you're paying the taxes, you're paying the maintenance. If the roof breaks, you're fixing it. And there's the escalators every year. The rent goes up, right? So that's typed into. That's how this dividend has been growing for 50 years. Realty Income, they sign these 10, 15-year leases with companies. Well, they can project out income very accurately. And, that's something that I think every CEO in America would love to be able to do. And this company can probably do it better than everybody else.
Absolutely. And again, it's not only the internal growth. Again, this is kind of the myth. It's not only internal growth that you mentioned, Nick, the lease increase, the lease bumps, but it's also the external growth, the acquisitions. And again, I got to reiterate, this is such a fragmented market. So you're going to see companies like Realty Income and others that we cover, and there's quite a few net lease REITs today, that are going to continue to scale and grow their businesses. And the ones that you want to own are the ones that have those dominant cost of capital advantages. Listen, I'm going to wrap this thing up here. It's been great for this first inaugural show. Nick, I know we've got something really special next week. Can you touch on it?
Yeah, it's just, I guess, first of all, if you guys are still here with us, thank you so much. It means the world to us that you've stuck around. Hopefully you learned something. Hopefully you were entertained. Feel free to leave us a critique in the comment section. Like, this is our very first show. We're open to constructive criticism, and we definitely want to kind of give the viewers what they want. With regard to that, a couple days ago, the S&P 500 hit that negative 10% mark, into correction territory. And Brad, I know you and I have, a lot of people have both been coming to us, asking us what to do. You can't turn on CNBC, Fox Business, any of these places without hearing the word recession, a dozen times an hour. I know a lot of people are concerned about what's going to happen to the market. A lot of these kind of Trump policies are for lack of a better term, kind of all over the place. And there's some speculation as to why that is. We're actually think there may be kind of a recession in the works. He might even want one to kind of get interest rates lower in the short term. So that's kind of what we want to talk about next week. Kind of what's going on in the world today? Will it lead to a recession? But more importantly, what does that mean for investors, and how do you navigate that? And Brad, you've kind of got a catchphrase that you've been falling back on for as long as I've known you. And I think that's probably a pretty good place to end the video. So why don't you explain kind of, your investing mantra, and then we'll see you guys next week. And please leave a like and subscribe to the channel if you've enjoyed this video.
Great. Well, as I mentioned earlier, Nick, I was a real estate developer, and it was that great recession that happened in 2008, 2009 that caused my whole career to turn upside down. And I lost a lot of money, millions and millions and millions of dollars, as a result of a bad business partnership, as a result of an economy that nobody could have predicted, a black swan. And so now here I am, 15 years later, one of the most followed writers on Seeking Alpha. But now I'm taking the collective wisdom, I guess, over the last 30 years as a private real estate developer, an investor, and now a Wall Street writer. And that's what Wide Moat research is all about, frankly, is to protect principal at all costs. Because when you lose a lot of money like I have, you don't want to see it happen again. And most importantly, I don't want to see anybody losing money. So our mantra here, Nick, to your point, is sleeping well at night. We call it swan investing. And that means simply we want to help you protect your principal at all costs. And that's what we're going to try to do each and every week here at the Wide Moat Show. I want to thank everybody for being part of this. We'll catch up with you next week. Drop us a comment below, please. And I'll be sending out a book every week. Thanks for joining us. See you next time.
Yeah, thank you guys. See you. Thank you for watching this episode of the Wide Moat Show. Below, there's a link to our free daily newsletter, the widemoatdaily.com. Please click that link to receive your free content and Brad's #1 Swan Stock Report. That'll go straight to your email, and we appreciate you guys stopping by.